Applied Digital posted a 407% revenue jump, but the actual recurring rent is only about $50 million a quarter, and the real money doesn't hit the tape until 2027. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Applied Digital, ticker APLD for Q4 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. Alright, on the revenue line, Applied Digital came in 181% above estimates, which sounds absolutely nuts. But before we party, a big chunk of that was one-time construction billing they passed through to the tenant. The clean recurring rent number was closer to $50 million. So the headline is real, but it's not what you want to anchor on. And on EPS, they beat by 111%. Here's the wrinkle though. The GAAP number actually shows a wider loss because they took a $117 million hit on stock comp tied to a corporate separation. Strip that one-time item out and adjusted net income was actually positive at about $13 million, which is a real operational swing from the loss they posted last year. So on the beat itself, and remember, we grade against the clean numbers, not the fit-out inflated headline. This still earns an A. A clean revenue print that more than doubled versus the durable rent base, plus a genuine swing to positive adjusted net income, is a monster print no matter how you slice it. And on consistency, Applied Digital has been delivering these blowout beats quarter after quarter as the hyperscale platform ramps, so this earns an A as well. First off, the top-line growth is genuinely staggering. Revenue up 407% year over year to $258 million. Now, like I said, a big piece of that is one-time construction billing, but even the underlying rent line is scaling fast as buildings come online. Next, they signed 3 brand new 15-year leases with the same top-tier hyperscaler across 3 different states. 15-year take-or-pay contracts adding roughly $20 billion of locked-in revenue. That is a franchise-level validation event. Add that to the existing book and their total contracted portfolio is now 1.4 gigawatts of capacity worth about $36 billion in base rent and $86 billion if the renewals get exercised. That's the number that reframes the whole story on this stock. On the financing side, they closed $3.74 billion of new senior secured notes at 6.75 and 7% coupons, which basically fully funds construction on the current pipeline. So the capital raise overhang everyone was worried about is largely handled. And on the earnings side, adjusted EBITDA swung to $42 million from just $1 million a year ago. That's the platform proving it can throw off real cash the minute buildings actually energize. So on profitability, I'm giving this a B, driven by that clean swing to positive adjusted EBITDA and positive adjusted net income. It's not an A yet because most of the earnings power is still ahead of them, but the direction is unmistakably right. First up, GAAP net loss widened to $110 million in the quarter, and even though most of that was one-time stock comp from the corporate separation, that's still a real hit that shows up in the reported numbers and drags on the tape. Next, and this is the one that keeps me up at night, around $20 billion of that $36 billion backlog is riding on a single unnamed hyperscaler. Take-or-pay contracts and investment-grade credit help, but if that one customer ever pivots, the whole equity gets repriced overnight. There's also a 12 to 24 month cash burn bridge before the new leases actually start paying rent. Applied Digital has to service almost $3.74 billion of new debt through that window, so any hiccup on construction or interconnection makes the balance sheet math tight. And on execution. Only 175 megawatts of that 1,410 megawatt contracted book is actually live today. The rest is spread across 5 campuses in 3 different states, and any delay compresses the returns on multi-billion-dollar builds. Last one, and I've said it twice already because it matters. The reported $258 million in Q4 revenue was heavily flattered by roughly $152 million of low-margin pass-through construction billing. The durable rent stream is way smaller, and that's the number you actually want to model. So on guidance, I'm putting this at a B. They didn't give a formal number, but that $36 billion contracted backlog is arguably better than any forward guide because it locks in 15 years of visibility. And on red flags, I'm at a C. The single customer concentration on $20 billion of backlog, combined with $3.74 billion of new debt going into a 2-year cash burn window before rent ramps, is exactly the kind of thing I can't dismiss. Putting it all together, this was a transformational print, not just a clean beat. Applied Digital went from a speculative AI data center story to a real hyperscale landlord with 15 years of contracted cash flow. The headline numbers are inflated by pass-through construction and hurt by one-time stock comp, so you have to squint past both. But underneath, the backlog and the debt raised together validate the bull thesis. The only real question left is execution over the next 2 years, and for that reason, I'm giving this print a B+. Real quick before we get into the report, if you're getting value out of these review videos, do me a favor and hit that like button and subscribe to the channel. It's completely free, it takes 1 second, and it's genuinely the biggest thing that helps this channel keep growing. Alright, let's get into it. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The story here got a lot stronger with $36 billion in 15-year take-or-pay contracts. This is no longer a speculative developer. It's a contracted hyperscale landlord. But I'm not chasing this rally, because the earliest meaningful rent from the new leases doesn't show up until 2027. There's a lot of runway before the cash actually lands. My plan is to sell cash-secured puts at strikes well below where we are now, on construction headline dips or broader AI infrastructure weakness. That way, I harvest the elevated premium and leave room for the inevitable drawdown. So for me, I wait for a pullback and let the news calendar hand me a better entry. When I'm sizing my cash-secured put strikes here, I assume a construction delay or a power interconnection headline can knock this stock down 15 to 20% inside a quarter. So my strikes sit well below the current price, deep enough that I genuinely welcome getting assigned. I'm avoiding at-the-money strikes even when implied volatility spikes and the premium looks juicy. The calendar between now and 2027 is packed with binary milestones, and the current rent base is only around $50 million a quarter, so any construction slip compresses the multiple fast. I structure these as multi-month expirations to capture the elevated volatility across the curve, and to reduce how much a single headline changes my assignment odds. So my play is straightforward here. I sell deep out of the money puts and let time do the work. I'm holding my shares here and looking to add on weakness rather than trim. 3 sequential leases with the same investment grade hyperscaler is a genuinely thesis validating event, and management delivering the 75 megawatt phase 1 on schedule proves they can execute. My posture is to let this ride toward 2027, when the market starts pricing contracted cash flow on visible earnings before interest, taxes, depreciation, and amortization, rather than on backlog dollars alone. The zones where I'd add are construction headline pullbacks or broader AI infrastructure drawdowns. What I'm not doing is chasing strength into new lease announcements, because the market is clearly primed for those now. So the game plan is simple. I hold an add on weakness. The next 90 days here are loaded with catalysts. More lease signings on the 1.7 gigawatts still being marketed. A possible investment grade rating on CoreWeave that triggers the Building 4 assignment, and more building deliveries. Any of those could be a double-digit upside pop. So for my covered calls, I'm picking strikes far enough out of the money that a 10 to 15% rally on a single lease announcement doesn't blow through them. At the money writing right now is just too risky, given what's on the calendar. If I'm holding a call through a specific catalyst window, like an expected lease signing, I either close it early or roll it up and out to protect against the pop. Longer dated out of the money strikes are letting me capture strong premium without capping the near-term upside. So for my calls here, I sell further out of the money and give this room to run. Leaps holders have arguably the cleanest setup on this name. The contracted 1.4 gigawatts of backlog, generating $36 billion in base term revenue over 15 years, gives me a real cash flow floor to underwrite a 2027 to 2028 repricing. As the buildings energize one after another, the market goes from modeling backlog dollars to modeling actual visible earnings. That's the moment my long-dated calls really pay off, so I want expirations that fully capture the ramp into first full year rent. If the stock trades off on a construction delay or a dilution headline, that's my window to roll strikes down and lock in the improved thesis at a better cost basis rather than trimming the position outright. So for my leaps, I roll out to 2027 or 2028 and let the story play through. If I'm sitting underwater on this print actually validates the original bull thesis rather than breaking it. The 3 anchor leases and the $3.74 billion in debt financing directly answered the 2 biggest bear arguments: customer concentration and construction capital. So averaging down is defensible for me if my position sizing allows it. I'm anchoring my adds to construction milestone pullbacks or broader AI sector drawdowns, not random weakness on a red day. The thing I'm watching closely is any hint of construction delay or power interconnection slippage on the Louisiana or North Dakota campuses. If that shows up, I stop averaging and reassess. As long as they keep delivering on-schedule megawatts, like they did with the 75 megawatt phase 1, there's 12 to 18 months of catalysts to recover into. So my approach here is patient. I average down on real dips and let the thesis play out. Bottom line, this print earns a B+ from me. Applied Digital is a materially better company today than it was 3 months ago, and the story now hinges on delivering megawatts on schedule into 2027. That's what I'll be watching.